Hey guys, Ken Boyd with the Accounting Accidentally website. Remember that you can go to the site for over 400 blogs on accounting and also find links to over 400 now of my YouTube videos that all explain accounting and finance. And what I wanted to talk about was my most recent post, What a Pentagon Scandal Teaches Us About Accounting Changes. So, accounting adjustments can be a red flag for an auditor. And what I want to make a distinction between is adjustments that an accounting department makes every month and accounting adjustments that an auditor finds after the financial year has ended. Okay? If a company has experienced accounting staff and strong internal controls, they're going to get most things right. Accounting entries are supported by source documents. The accounts are reconciled in a timely manner. All this creates accurate financial statements. What does that mean? Company stakeholders, including investors, creditors, vendors, regulators, have confidence in the financial statements. They know what they're getting is accurate. Several types of adjustments are posted during a typical month and year. And this is a summary of 4 adjustments that I actually created in one of my accrual and deferral YouTube videos. So, 4 common adjustments. First, we need to understand accrual accounting, which matches revenue earned with expenses incurred to produce the revenue. It's a match. What accrual accounting does not do, it does not post income or expenses based on cash inflows and outflows, as you'll see with these examples. And it's a more accurate way, it's thought, to calculate business profit. So, 4 of them. These are the common adjustments made to comply with the accrual basis of accounting. Convert an asset into an expense. This is probably the easiest one to think about because we've all dealt with, I'm going to close my other computer here. We've all dealt with depreciation expense, and it's an easy example that we use in accounting. Assets are purchased to generate revenue. You think about a plumber driving a truck. That truck is out on the road to produce revenue for the plumber. When you use assets in your business, you convert an asset balance into an expense over time. Each year the plumber uses his truck, he recognizes depreciation expense and accumulated depreciation for his truck. If you want to know what the asset is worth today, the book value or the true value is the cost of the truck, the original cost less accumulated depreciation. So posting depreciation expense, common adjustment. Converting a liability into revenue. The common example is customer deposit. If a customer pays a deposit, the balance can't be posted to revenue until you deliver a product or service. When the deposit is received, you debit, increase cash, post a credit to customer deposits, a liability account, because if you never delivered a product or service, in theory, you'd have to give the money back. Once the product or service is delivered, you debit to reduce customer deposit, the balance is zeroed out. You credit to increase revenue. Accruing unpaid expenses. We hear a lot about accruals, a common one being payroll. If you owe employees $3,000 in payroll at the end of December, you post an accrual to recognize the expense in December when you paid the workers, when the workers earn the pay. When you run payroll in early January, you remove the accrual. This approach posts the payroll expense in the period when the work was performed, which is December. This is all about matching. And finally, accruing uncollected revenue. Let's say you're owed interest on a certificate of deposit, but the bank hasn't paid you as of December 31st. So what do you do in your accounting records? You debit to increase accounts receivable. You credit to increase interest income for $50 on 12/31. And one thing you'll notice here is that in each of the 4 cases, we are posting an entry to a balance sheet account and an entry to an income statement account. Accrual entries are day-to-day normal accounting transactions, but the problem comes up if adjustments are required after the period ends. That's a problem because if we look at the payroll example, you don't make that $3,000 payroll accrual. If you don't make it, you're not posting the expense in the right period. So I about fell out of my chair when I read about this recent Pentagon audit. And what MSN reported was over $500,000 in adjustments at the Pentagon for fiscal years 17 and 18, according to Government Accountability Office, GAO, that investigates and holds departments accountable. Huge number, $16 trillion worth of adjustments. So, how did it happen? Well, generally speaking, the combined errors, shorthand, and sloppy record keeping by DoD, Department of Defense accountants, added up to a number nearly 1.5 times the size of the U.S. economy. So can you imagine if the Pentagon was a for-profit entity? No stakeholder, investor, creditor, vendor, regulator would have any confidence in the financial statements, and why should they? And the problem is a weakness in internal controls, and I wanted to mention a few internal control issues. Source documents. Every accounting entry must be supported by source documents. Invoices, you've got to use purchase orders. If you receive goods, you match the shipping receipt that you got with the goods to the purchase order to make sure they match. So get source documents squared away. Another internal control is don't fall behind. The classic example is not reconciling accounts, particularly bank accounts, on a timely basis. Bank accounts are particularly critical because the cash account typically produces more transactions than any other account, which increases the risk of error or even fraud. The best way to catch fraud is to reconcile your bank account. The longer you put off reconciling the account, the harder it will be to uncover errors. So don't fall behind in your accounting. It just makes life harder. And finally, consistent use of accounting principles. Accountants like apples to apples comparisons. You've got to use the principle of consistency, which says you need to stick with the same accounting method each month and year, and if you decide to change, you need to have a good reason. So think about revenue recognition. Your policy is to post revenue when a customer order is shipped, and you've had that policy for years. Well, what if in December of the year you decided to post revenue when orders were placed rather than when customer orders were shipped? That's a problem because now you don't have comparison. You have an apples to oranges comparison. Specifically, you can't compare the December results, the new policy, with the November activity, which was based on the old policy. So a change in accounting principle can be a really red flag that management is trying to manipulate the financial results. Fortunately, accounting standards require firms to disclose the financial impact of both the old and the new method. It's a little tough these days to manipulate the financial records given that amount of disclosure that's required. So summing up what's in my post this week, what's the lesson? Every business posts accounting entries, adjusting entries to comply with the accrual method of accounting. That's perfectly normal. Adjustments required for a prior period, including those identified by an auditor or an indication of poor internal controls. Thanks for watching the video. Remember, you can go to the blog and get over 300 posts. You can also get links to over 400 YouTube videos from my home site. 50 Stories that Explain Accounting will be out in 2020. You can join Conference Room, where we have courses, blog posts, other information if you want a deeper dive into what I do in the accounting space. Get answers to pass a CPA exam and learn accounting concepts. Thanks very much for watching. We'll see you next time.